Sometimes forex trading is a wild and woolly place to be. That's why Hugh's here, to pose your questions to Walter, the naked forex guy. Hugh's got questions and Walter's got the answers. Here at the Truth About FX podcast.
Hey Walter, how's it going?
Great, Hugh. How are you today?
Oh, pretty good. Today's question is, I figured out that I'm not really interested in trading for myself, but I would still like to take advantage of the opportunities in forex. What should I do?
This is a good question. From my point of view, what I do in these situations is I will send people to my students who have a really good track record. If you're interested in kind of matching up your goals with the style of someone I know who's quite good. In fact, I just got this request last week where, you know, a trader that I know who actually trades quite well is looking to diversify with the monies that he's collecting, and so I'm hooking him up with students that I know are consistent and profitable. So that's one thing that I do, but here's the thing. Here's the tricky part of this. You really have to be upfront about where you would draw the line and say I'm gonna stop investing in this person or in this fund or whatever. So there's lots of ways to do it. Probably when someone's first starting out and they don't have a lot of money, you're gonna have to kind of line up with someone who's a trader who has a pooled fund that they trade. But it's a little bit more complex than that, because you have to be honest with yourself and say, am I really gonna be able to withstand a 30% drawdown or a 10% drawdown or whatever, and then ask that person that you invest with, what's their drawdown been. And then try and, what I like to do is try and maybe double it or add a 50% to that. So if they tell you they've had a 10% drawdown max over the last 5 years, you might just assume that you're going to hit a 15% drawdown in the future or a 20% drawdown, and ask yourself if you can sit through that. So that's really that's the tricky part, because when it comes to managing money, the clients often will draw a straight line to the moon, and they just think, oh, okay, well, they made 10% last month, or like you were saying, Hugh, you before this we were talking, you were up 7% this week, or last week, or that kind of thing. So people start doing like, oh, okay, that means I want to make 28% a month for the next 5 years or whatever. That just doesn't happen. So that's the big thing, is to look at the negative and say, okay, be honest with yourself. How far could I go if I give this person $100,000? Could I really sit through it if it ends up dipping down to $80,000? That sort of thing. So that's the tricky part. I don't know. Do you have any thoughts on that?
No, not really. I think you covered it all. It's a great point that you really have to. I mean, even if somebody else is handling your money, it's also trading. So there's going to be ups and downs, and you can't really draw a straight line. And even though they might have a stellar track record, this is something I'm actually going through in another account that I have. One of my buddies is trading the account. And last year he did 50% December, 60%, 50% in November, 60% in December. And then in the beginning of this year, he's kind of like dropped off like 5%, 2%, which is still, fantastic. But it's obviously not what he did last year. So you can't really expect that.
Yeah. I mean, that's it. I mean, it's all kind of a reversion to the mean, isn't it? And the other thing is, you might actually wait for that sort of thing before getting in. So a lot of people, what they do is they jump into a fund, or they send money to a trader right after that trader has a good month or a good stretch, and then this is what happens, right? It goes back a little bit. So what you might actually do is the opposite. And this is what a lot of really savvy funds will suggest that you do, is you wait until they have a negative month or two, or you wait until they have subpar results, and then you invest, because it's kind of like you're timing it's almost like you're trading the pullback in the fund or in the trader, you know what I mean? So that's another way to approach it, is to not jump on the bandwagon after a really good stretch, but rather wait till they have a poor run and then load your money in and do it sort of like that. But that's another approach.
Yeah, totally. Yeah. And I was talking to Mike Melasinos, and he runs a trend following fund, and I think there's no other strategy in the world that's more that you need to do that more. So, so if they're down, that's when you need to get in, because trend following has a real big run up, and it can also have some real big rundown. So you bring up a great point in that.
Absolutely, yeah. That's the ticket with trend following. You got it. Yep.
Okay, well, thanks for your insights. Talk to you soon.
Thanks a lot.
Yeah.
See you soon. Bye.